Hello everyone, welcome to the Capital Intelligence channel. Jump straight in. Look, today we're decoding something truly fascinating. We're looking at exactly how billionaires, the ultra-wealthy, literally turn market panics into generational wealth. If you're serious about your finance and investing journey, this explainer is absolutely essential. We're going to break down the highly structured, almost architectural playbook the elite use to deploy their capital when everyone else is running for the hills. Because guys, it isn't about luck. It's a highly systematic, engineered approach that turns systemic volatility into a massive financial advantage.
Okay, let's dive into this. Look at this quote from General Oliver Cromwell. "Put your trust in God, my boys, and keep your powder dry." This perfectly sets the tone for how the elite prepare their capital. Historically, keeping your powder dry meant literally keeping your gunpowder ready for battle. Well, in the financial world, it's the absolute foundational rule for the smart money. You just can't capitalize on a crisis if you don't have the ammunition ready when the smoke finally clears, right?
So here's the tactical blueprint we're decoding today to give you those high-value insights. We'll cover 1, the contrarian mindset, 2, the power of dry powder, 3, the Lombard lending secret, 4, pivoting to private markets, and finally, 5, the macro effect. Let's just jump right into that first pillar.
Section 1. The contrarian mindset, going against the herd. To really grasp crisis opportunism, we've got to look at the psychological dissonance of a market crash. You know, when a crisis hits, there is this massive split in human behavior. While the general public sees the world collapsing and heads for the absolute nearest exit, the ultra-wealthy, they see a rare, rapidly closing window for wealth creation. Just look back at the most terrifying financial moments we've lived through. Black Monday in '87, the 2008 financial crisis, the 2020 COVID crash. Legends like Paul Tudor Jones and Warren Buffett, they didn't hide. No way. They used these exact terrifying moments to aggressively deploy their capital. They stepped in when there was blood in the streets, snatching up distressed assets that were fundamentally strong, but just crushed by sheer, unadulterated panic.
And the difference between the retail reaction and the smart money playbook, it's staggering. I mean, the average investor is biologically wired for loss aversion. When your portfolio starts bleeding, panic selling kicks in just to make the pain stop, but billionaire investors somehow bypass this biological herd behavior entirely. They operate with this ruthless discipline. To them, a structural correction of 20 to 50% isn't the end of the world. It's simply a once-in-a-decade flash sale on phenomenal companies.
To wrap your head around the sheer scale of this opportunism, just listen to this number, $2.6 billion. Just let that massive profit sink in for a second. That is the windfall hedge fund manager Bill Ackman made in the span of just a few weeks during the 2020 coronavirus meltdown. While global markets were literally in freefall and retail investors were dumping stocks at any price they could get, Ackman had positioned his portfolio to massively capitalize on that downside volatility. He essentially turned global panic into billions.
And it brilliantly illustrates the concept we saw play out with another legend back in 2008, $5 billion. At the absolute darkest moment of the financial crisis, when legendary institutions like Lehman Brothers were just vanishing and Goldman Sachs was teetering on the edge, Warren Buffett stepped in. He threw a $5 billion lifeline to Goldman. Now, he demanded incredibly favorable terms, obviously, and ultimately walked away with billions in pure profit. He became the ultimate liquidity provider when absolutely no one else had the courage or, more importantly, the cash.
Section 2. The power of dry powder, strategic liquidity.
Look, having a contrarian mindset is completely useless if you don't actually have the fuel to execute the trade, right? Enter dry powder. It's exactly what it sounds like. It's defined as cash reserves, money market funds, or highly liquid assets, think short-term treasuries, that are maintained specifically to be deployed during times of economic stress. It's that bucket of cash just sitting on the sidelines. The ultra-wealthy do not stay 100% invested in volatile equities all the time. They meticulously build up these dry powder reserves. That way, they've got the ammo ready to go when valuations plummet and the rest of the market is completely strapped for cash.
Section 3. The Lombard lending secret, unlocking liquidity. So, what happens if an elite investor spots a generational opportunity, but their cash is tied up in other long-term investments? Well, they use Lombard lending. This is a highly effective, almost hidden banking mechanism that lets the wealthy access cash without actually selling off their portfolios. Basically, it's borrowing against existing liquid assets, like a massive stock or bond portfolio, while keeping full ownership and investment exposure. Instead of selling your blue-chip stocks to buy a distressed asset, you just pledge your portfolio to a private bank as collateral. The bank hands you a swift line of credit, often within days. This lets you seize a time-sensitive opportunity without blowing up your long-term wealth strategy.
Let's move to the next step and see how this builds mechanically. It's a precise four-step process. Step 1. The investor pledges their existing, high-quality assets to the lender. Step 2. They instantly access a credit facility, usually based on a percentage of that portfolio's overall value. Step 3. They take this fresh cash and deploy it into deeply discounted distressed assets right in the middle of a market panic. And Step 4. This is the magic part. They retain all the growth and dividends of their original portfolio because, well, they never actually sold a single share. The crucial point here really comes down to mechanical efficiency. Think about it. If you simply sell traditional assets to raise cash, you trigger a massive capital gains tax event, you interrupt the compound growth of those assets, and honestly, it can take weeks to clear and settle. But with the Lombard loan, that tax event is entirely avoided because debt isn't taxed. Your asset growth is perfectly preserved. And the speed of execution? We're talking days, not weeks. It is an incredibly powerful tool for tax efficiency and agility. It's exactly what the ultra-high net worth rely on.
Section 4. Pivoting to private markets, building the moat. Now, once the crisis passes and these opportunistic investments start yielding massive returns, the strategy naturally shifts toward building a moat. This is how family offices and billionaires protect their newly minted wealth from the exact same public market volatility they just exploited. To secure this wealth, these ultra-high net worth investors aggressively pivot into specific private market sectors. We are talking private equity, private credit secondaries, direct equity, and global infrastructure. These spaces don't trade on public exchanges. That means they don't fluctuate wildly every time there's a scary news headline or retail panic.
As outlined by the wealth management firm Creative Planning, private markets definitely come with distinct trade-offs. On the pro side, you're looking at enhanced returns, true portfolio diversification, and excellent downside protection. The cons? Well, higher fees, a lot more complexity, and illiquidity, meaning your money is locked up for years. But here is the critical insight for serious investors. Billionaires actually view this illiquidity as a feature, not a bug. They call it the illiquidity premium. By agreeing to lock their money away, they get compensated with higher, more stable returns that are permanently insulated from the daily hysteria of the stock market.
Now, what's really interesting about this slide is the sheer consensus among the elite. A staggering 81% of family offices currently identify private debt and direct lending as offering the absolute strongest risk-adjusted returns. Why? Because traditional banks have really pulled back on lending lately, so family offices are stepping in to act as the banks themselves, earning incredibly high yields on private credit secondaries. It's a massive structural shift away from public market volatility and straight into private contractual income.
Furthermore, billionaires like Bill Gates and Warren Buffett, they hold massive portfolios of global infrastructure assets. We're talking energy grids, digital infrastructure, huge supply chain logistics. Why do they do this? Because infrastructure provides highly defensive capital growth and, crucially, inflation-protected income. When geopolitical risks flare up or we hit major energy shocks, these essential services just keep generating consistent, enormous cash flows, pretty much across any economic cycle. It is literally the ultimate macro defense.
Which brings us to Section 5, the macro effect, shaping wealth inequality. Having seen the actual mechanics of how this playbook works, we need to neutrally examine how these wildly divergent investment strategies impact the broader economy over the decades. Research shows a pretty stark divergence in outcomes. The typical retail outcome during a severe crisis, it often involves selling at the absolute bottom, which depletes portfolios and causes them to completely miss the subsequent market rebound. Conversely, the ultra-high net worth outcome, which we now know is powered by dry powder, Lombard lending, and contrarian buying, results in preserved capital that aggressively compounds into generational wealth. Impartially speaking, this structural difference in how panics are navigated is absolutely one of the fundamental drivers of global wealth inequality over time. So, having walked through the systematic architecture of crisis opportunism, we're left with a really critical question to ask ourselves. Will you treat the next market crash as a panic? Or will you use this structural playbook to treat it as an opportunity? Understanding these elite mechanics is really the very first step in taking control of your own financial journey. Thank you so much for joining me on this explainer today, and I'll see you in the next one.